Couple of announcements before I begin this week. There are a couple of fake profiles that are meant to look like me. So if you're on Discord, I will never ask you about your investments. I will never ask you if you want to be in an investment. I'll never solicit you for funds. Unless you contact me, there's very little reason why I would contact you for anything. The only way to get into Discord is through the Mark Meldrum website. I will never contact you out of the blue and say, hey, would you like to join my server? So if any of these two profiles are contacting you, it's not me. The first one here is Mark.5297. I have an M in there, so it's missing the M. This is a fake one. The next one has the M in here, but instead of 5297, has 5927. So this is another fake one. These people who do this will always be with us. This is the burden societies carry, which is the left tail. These people really have nothing in life that they can do other than this, is imitate other people and attempt to steal from people. It's all they know how to do. Just be aware, I will never solicit anything from you in terms of investment. I will never ask you to join me on WhatsApp. I'll never ask you to join me on Telegram. If that's happening, it's not me. Okay, second announcement. This is for applied asset management. Either you have the applied level or you just have the applied asset management. Screeners, this has been up for a while. We've developed a momentum screener using Python. The code is available for you if you have a subscription to this module. If you look down the menu list on Discord, if you look all the way down the menu list, you'll find screeners, and then you'll find one for momentum. And this chart is up at regular intervals, which identifies a particular ticker, the current price, its 52-week high, and the distance it is from the high along with a volume ratio. So this is saying that this stock is 0.24% from hitting a 52-week high, but it's doing it on 75% of its typical volume. Usually you want to see bigger volume. JCI, for example, is 0.61% away. This is as of May 22nd. It's 0.61% away, but doing it on 114% of its volume. The channel just above it has the rules for what would qualify as momentum. When you do a screener, you'll get a bunch of near breakouts, but you may not get any momentum, especially on a day that sells off. So it may, at the bottom of this list, if you read it all the way down, say no momentum candidates found. For any momentum candidate, we have a momentum portfolio. IBKR allows sleeves, so you can take your account and you could say, I would like a sleeve of this account managed by, and you identify somebody who will manage that sleeve for you. So I started the process of creating $1 million sleeve off of the account that I have, and any candidate, any stock candidate shows up satisfying the rules of momentum, it will be an automatic purchase of $10,000, which means we can hold 100 positions in this portfolio, or take 100 positions. And of course, there'll be a risk management rule, a risk elimination rule, and a take profit rule as well associated with these. So there'll be an entry rule, risk management rules, and an exit rule. And basically, it's just going to be formulaic. If it shows up on the momentum screener, if it passes the 2 tests, or I think we have 3 tests required for it to be then it is an automatic purchase of $10,000, and we'll just keep doing that. I mean, if we have 100 positions and the thing is performing well, I'll put more to it. So that portfolio will be published along with its performance. That'll be published as well, and these lists are published. And since we give you the Python code, you can actually run these yourself. You can even modify the rules within the code. Third and last announcement before we head in, this is for the module Applied Analysis. So either you have that module directly or you have it within the applied level. I've started to build out a separate module for AI in finance. So we have AI for finance intro, how I use LLMs. This is another PhD that is doing this one. This is a 2-hour video that I curated from YouTube. There's some good people on YouTube doing stuff, and there's a whole bunch of just, especially in this space, just a whole bunch of stuff that really isn't very helpful at all. Understanding LLMs, I did this one. These 3 are from another PhD on YouTube. And on Monday, we'll look at, oh, sorry, no, I already did this one. Notebook LM with Costco, we already did this one. On Monday, this is what we're going to do. We're going to take Costco's 10K, and we're going to use Google AI Studio. We haven't used that yet. We've just used Gemini and Notebook LM. We're going to use Google AI Studio, and I'm going to show you how you can get any answer to any question in a conversation using something called screen sharing. So we'll put the 10K up on the screen as a PDF. We will go to Google AI Studio. We will screen share. And once we screen share, the AI can actually read the document. So we can highlight something in the document and say, "Do you see what I've highlighted?" And it will say, "Yes, I do." We can say, "Can you explain that? I have no idea what that means," and it will explain it for me within the context of that PDF. So imagine having a tutor sitting with you at all times as you're reading a 10K saying, "I don't understand this transaction. What does this mean?" And it tells you, "Thank you." And then you continue on. I'm going to show you how to use Google AI Studio to get that done. So if you haven't already experimented with Google AI Studio, head on over there and have a look at it. I'm going to show you something in Google AI Studio near the end of this video. And being that I see AI, I'm going to draw a little chart just to give you an idea of where I am on my thinking here. And we'll say that this is today, time T, and this is, when ChatGPT first came out, and this is my level of how impressed I am. Let's say impressed. It was like this for a long time. It's like, oh, that's impressive, but it doesn't really answer questions. It's getting a little bit better. Yeah, it's getting a little bit better. We're doing this now. We're at this point right here where it is not just, yeah, that's kind of neat, but it's not really helpful for me because the output's got a lot of errors in there. I would ask it questions I already knew the answer to, and the output I'd read and go, okay, well, that's wrong. It would take me more time to fix it than to just do it myself. That's not the case with these new models. Gemini has 1 trillion parameters, and we're expecting OpenAI's 5 series on their LLM to be hitting soon. Expectation is over 1 trillion parameters. That is wicked. Whacked, as they say in Boston. This series will continue on. I don't know how long it's going to be, but every week the tools that are coming out are every week there's something new. Every week something new somewhere, and some new capability that can be done. So I keep trying to use them in terms of what can we do with the 10Ks and the 10Qs? What can we do with investor presentations? What can we do with a portfolio? What can we do with a peer group? All of these things to see what can be done. I don't know where it ends, so it's just going to be an ongoing module. I would say this: if you do not start learning these tools now, in 2 years you're going to be way behind. And it's not a question of, well, in 2 years I can figure it out. I could just start using it in 2 years, can't I? I want you to think that this is like 1992 and somebody showed you this thing called Lotus 123. It's a spreadsheet. And you looked at it and you said, spreadsheets, I don't see that. My calculator works just fine. Fast forward a couple of years, and if you're not listing spreadsheets on your resume as a skill, you've missed the boat. Those are table stakes. AI is a little bit different. You can just start learning it at any time. The interfaces make it easy to use, but your prompts, that's what's going to set you apart. I have one document now where I've already started generating a whole bunch of different prompts based on the success of those prompts. And these prompts might have, 20 to 30 iterations just to get the prompt right for a particular task. And then I get output where I go, this is it, this is exactly it. Then I save my prompt. Writing good prompts is both an art and a science. There are some rules to follow when writing a prompt, but you do have to say, okay, well, given the different contexts I'm in, let me try this, let me try that. So you have to be experimental. So imagine in 2 years you decide, you know what, I better learn this stuff. Somebody beside you already has a library of 50 to 100 prompts that are already perfect, and you're going to have to take the time to figure out what a good prompt looks like over time. So I would start now. These AI is a nice to have on your resume now. In a year, it'll be pretty much a need to have. In 2 years, you're obsolete if you are not using these tools. I am not kidding you. You are obsolete. This is a big general purpose technology that is going to change a lot of things. Just in my own regular day, the amount of support I get from these AI tools, the output that I can produce that I never thought possible. I would have aggressive plans for the week of what I want to get out, and I'd never hit those aggressive plans. Now I'm hitting them by Tuesday afternoon. That I'm seeing that I can double and even triple my output plans, and still maybe by Thursday afternoon I'm there. Get on board. Get on board now. Okay, let's have a look at rates and yields. And what a week we had. Started the week by absorbing the downgrade last week to U.S. debt. We had a 20-year auction that was deemed disappointing. Although if you look at it, it's like, well, it's a 20-year. It has a weird clientele effect. It's an odd tenor. I don't know that we want to read too much into the 20-year, but still, just to give you some idea, it had a bid to cover of 2.46. That means 246% was the demand. So if you were issuing 10 million, there were bids for 24.6 million. That's what that means. 2.46. Indirect bidders, 69% represented 69%, which is above average. So that is suggesting that foreign demand is still quite solid on this one. It hit at 5.04, and the 20-year was at 5.03 when the results were released. So, of course, the 20-year would then have to sell off to 5.12 because it went out at 5.04 when the market was at 5.03. Not enough to go to 5.04. It's like, oh my God, 246% demand, increased foreign demand, and 5.04. Let's take it to 5.12. It just seemed like an overreaction on that one. Money market rates all fairly well behaved out to the 4-month, and the 6-month and the 1 year have some basis points in there. And then if you look at the capital market, all the way up the belly of the curve, 2, 1, 2, and 5 basis points for the 2, 3, 5, and 7. 10-year added 8, the 20-year added 11, and the 30-year added 15. We're now 7 basis points away from a new cycle high. 27 on the 20-year, but still quite a distance on the 10-year. And in fact, if we look at the 10-year from the beginning of the year, 458 to 451, it is down 7 basis points. Not much, but it's down 7 basis points, considering everything that we've thrown at this market, including the big, beautiful bill. And I am not kidding, that is what it is named, the big, beautiful bill. It is named that. Including that, which shows that the deficit is going to be just as bad as it was the last 4 years going forward for the next 4, and the debt. We are, I think, past sustainable at this point. So we'll talk about that shortly. But overall, the capital market curve, I think, came out of the week fairly okay. Once you get above 5% on the 20 and the 30, it becomes a viable investment for many funds that have very long-term horizons against liabilities. So you can think of insurance and pension funds. This becomes a no-brainer. It's like, you're going to give me over 5% for this for the next how long? How much of my return is now fixed just because of that? I'll take it. June 18th, we have our next FOMC. I think they can cut, but still the market's at 98% that they're not going to do anything. Up from 91%, 98%. Call that just a rounding error at 2.2, but the market is saying no, nothing really much is going to happen. You have two fights going on. You have the tariff fight at one end, which is going to be, and I'm doing air quotes here, inflationary, even though the goods sector makes up less than 20% of the economy. Services make up the rest, and the imports don't represent 20% of the goods sector. And when it comes to the imports, some importing countries are absorbing part of it. Some importing companies are absorbing part of it. Some of it, of course, is going to be passed through, but it's only in goods. At the other end, you have a general purpose technology that is accelerating at this point. A year ago, I would have given most AI output a failing grade, if not an outright D. Would have been comparable to what I'd expect from a high school student. Not now. Now I would give it a B to B plus. The output that most of these LLMs give now is what you would expect from an average employee who is otherwise qualified on paper. It is average output. It's not A plus, but it's average output, enough that it saves me a considerable amount of time, and I don't think that I'm the only one. So you have that on the other end, which I think is the bigger deal, which I think is deflationary. And you've had 2 months of CPI and PCE. Well, we'll find out this week about PCE, but usually it follows CPI. 2 months saying this doesn't appear to be a bit of a problem. I think they can cut. I think they should cut. I think they have to cut. I don't see another alternative. I'm going to show you some information from the Treasury soon on interest expense, an average cost of debt and the size of the debt. I want you to think of Powell as the cook on a ship. He has a job to do. He has a task to do. But if the ship is sinking, what do you need a cook for? You need this cook to stop, get out of the kitchen, and start bailing water. The ship is sinking. We don't need the cook doing what the cook is doing, saying, look, bailing water is not part of my job. It's outside my mandate. Yeah, well, the ship is sinking. So, work towards your dual mandate as much as you want. It's on a sinking ship. It's not going to matter. Powell is speaking today at 2:40 p.m. I'm doing this Sunday. It's 10:04 a.m. This is 2:40 p.m. He is speaking. Monday markets are closed. Last week I said Monday markets are closed because I'm in Canada and I'm getting notices from Interactive Brokers, and my laziness last week, and I was also still getting off my illness that I had while I was in Europe. I just concluded, oh yeah, that's right. Usually Canada and US have holidays pretty much the same days for most of the holidays, and we're a week apart on this one. We had Victoria Day in Canada on Monday. You have Memorial Day coming up on Monday in the US. So Monday, the US is closed. Closed. Tuesday, durable goods. Wednesday, the FOMC minutes. That will be an interesting read. Thursday, you have your second look at first quarter GDP, and you'll also get GDI, gross domestic income, at that time. So that will be, we didn't have a very good first look. Let's see if the second look improves or gets better. Friday, in Canada, we have April GDP. That's a preliminary number. You also have US PCE and consumer sentiment. This gets watched more and more. PCE usually follows the same direction as CPI. I don't expect any surprises here. I expect to see that inflation is not a problem for the second month in a row, reflecting a full month where you've had 10% tariffs across the board. The CPI was unimpressed. The PPI was unimpressed with it all. I think PCE will be unimpressed with it all. I really think we have permission here. A lot of Fed talk this week. Tuesday, you have 2 of them. Wednesday, you have 1. Thursday, 1, 2, 3, 4, 5 of them. And Friday, you have another 2. Auctions coming up this week, being that the 20-year rattled markets. Let's pay attention here. You have a 5 and a 7. Those aren't going to be a big deal. Big deals, I think, are going to be the 10 and the 30. Auctions on the 10, auctions on the 30. Reverse repo at 154 billion, reserves 3.3 trillion. TGA sitting at 475 billion. The big, beautiful bill raises the debt ceiling considerably. So we won't have to worry about that. But you got to get past the Senate. And the Senate has its own problem. So what we have out of the big, beautiful bill is probably not what's going to pass the Senate. We'll spend some time on that as well. The other issue with the long end of the curve, we're going to highlight some issues with U.S. debt, that it is already beyond sustainable. So one of 2 things, preferably 2 things, have to happen with at least one of these 2 things critically has to happen. Number 1, you got to get the level of debt down. Not going to happen. So that's not even worth talking about. The big beautiful bill increases debt. So we're still on the same hope of we'll grow our way out of this. This bill incentivizes growth in the U.S. The tariffs incentivize, we'll grow our way out of this. Every president says that. We'll grow our way out of this. Every assumption after introducing budget deficit after budget deficit, we're going to grow our way out of this. We're going to grow. Well, we're not going to grow our way out of this. So that's not going to happen. The other thing that has to happen is you got to get the cost of debt down. If you can't get the level of debt down for a given cost, you must get the cost down for a given level. And that relies on the central bank. That can be done, but it won't. Not under this guy. So not only is the U.S. unsustainable, but consumer credit is priced off this segment. Your car loans are priced off the 5-year. Your mortgages are priced off the 10-year. And a lot of debt is priced as a spread above a floating rate, a rate usually being a 2-year, a 5-year, or a 10-year. Not necessarily a money market rate, but a capital market rate. So the capital market curve, which is market determined, really sets the price for almost all credit you see in an economy. You have to flatten this curve in a very bullish way. You need a massive bull flattener on this curve. I'm going to show you shortly that you need it now. Let's look at Fed funds futures. I am making 2 big bets on the yield curve. I'm making a bet way down here, and I'm making a bet way over here. I was disappointed with TLT. I was selling calls on TLT, and I thought, I've given it 2 years. I've given it enough time. It's not performing, and I don't see the trajectory of U.S. debt getting any better. That I think maybe it's time to get out. I've changed my mind. It's time to get in. So I've actually been thinking about increasing my position, and I'm increasing my position over here on the ZQ, which is the effective federal funds rate. Here is the Fed funds price term structure. Let's look at this is October over here. This is January, and this is April. So October 95.86, 4.14. You have 3 meetings, June, July, September, to reflect the weighting over the course of October. What we're showing here, Q2 over here is 1 basis point. Going from Q2 to the end of Q3, another 18. And I say here you have 3 meetings before that and less than one cut. I do have a position in ZQ here. I have 4 different ZQs. I have a position in ZQ for October. If we go out to January, which represents the weighted average effective federal funds rate over the month of January, and since there's no meetings in January, it does reflect everything that happened to the end of December. You have October and December in here as well. So that makes 5 meetings in total, 3 plus 2, 5 meetings in total for 49 basis points. So over the next 5 meetings, 2 cuts over the next 5. The last summary of economic projections we had said you can expect 2 cuts. So the January Fed Funds Futures is pricing in those 2 cuts. Also with the June 18th FOMC, we get another summary of economic projections. Let's see where the dot plot is. If we go out to April, we're at implied 3.61, so 3.84 down to 3.61 is another 23 basis points, or 72 basis points by the end of Q1. Which encompasses 7 meetings. Let's get a full year in there. So we'll go out to May. Implied here 3.54 gives us 61 on a 54, another 7 basis points in cuts. So 79, basically 3 cuts over the next 8 meetings. And then if we go out to October of next year, you have another 3 meetings in here. That's 11 in total. Implied rate of 3.32. We're at 4.33, suggesting 100 basis points in cuts in 11 meetings, 4 in 11. I don't think so. I think it's going to be much more aggressive than that. So I have the October 25 ZQs. I have the January 26 ZQs. I have the May 26, and I have the October 26, with most of the weight showing up here. I don't know that I'll continue to add here. I'm adding, I think my average here is 95.80, 95.885, 95.89, which is 4.11%. We're at 4.33. If you get 1 cut over these 3 meetings, that would bring it to 4.92. If you get 2 cuts, I'm doing well on this one, plus all these will follow along as well. That's my bet on the short end. I don't think they have a choice. I think the data will be clear, especially if they don't cut in June. By the time they get to July, I think you're going to have 3 months in a row of very low inflation, if not outright deflation on CPI and PPI. That I think June, July, and September could both be cuts. Let's have a look at the debt. Let me bring something onto the screen here, just so that we have an idea of what we're looking at. To see how critical this is. This is interest expense and average interest rates on national debt from 2010 to 2025. If we start in 2010, interest expense $414 billion, average interest rate 3%. We're over that right now. There's the 3% here. You can see how the interest rate just declined over the decade. Time you get to 2016, you're at 2.32, 433 billion in interest expense. Let's go back to 2010, 414. Head to 216, 433, but the debt had increased enough over that period of time that you would think, well, the interest expense should be higher, but you're at 2.23. Here you're at 3.05, so that 70 basis points makes a difference. When we get into when we get to 2020 and even 2021, look at 2021, 562 billion. You have a lot more debt at this point, but look at your average interest rate, 1.6, a full 140 basis points lower than it was in 2010. but with a lot more debt. So you go from 414 billion to 562. Now look what happens. 2022, you went from 1.6 to 2, 40 basis points higher. You went from 562 to 719 because you have two bad things happening. You have the cost of your debt increasing and the size of your debt increasing at the same time. So it's like increasing a square by pulling on a corner. The length and the width are increasing, which means the area is increasing even faster, right? So you can think of the interest expense as the area. One side of the square is the size of your debt. Another side, we'll call it a rectangle. One side is the size of your debt. The other side is your average interest rate. Let's go another year. We went from 22 to 23, 2.07 to 2.97, 90 basis points, 719. Now you're at 883 billion. Let's go one more year. We went from 2.97, this is 2024, to 3.32, $1.13 trillion. That's just interest expense in 2024. Go back to 2014, just 10 years ago, it was 431 billion. This is 1.13 trillion, roughly about $700 billion more that you got to come up with just to pay this. Now let's move over to this last column. This is, as we see up here, fiscal year to date, which starts October 1st. So it's almost 8 months. 684 billion, slightly lower average interest rate, 3.289, down from 3.324. But the average, the interest rates on the capital market curve up to the 10-year are down for the year. Kind of flat on the money market curve because we've had no cuts. But the 2 years down 25 basis points from the start of the year. 3 years down 31, the 5 years down 30, the 7 years down 19, and the 10 years down 7. The 20 and the 30 are elevated, however. You wouldn't think so, right? Given the performance of TLT and you know how we feel about the bond market, you wouldn't think that we're down that many basis points, but roughly about one interest rate cut from the 2 to the 7. So that translates into an average interest expense of 3.289, call it 3.29, down from 3.32, 3 basis points. However, the run rate here at 684 billion, you are going to almost match last year's interest expense at a little over $1.1 trillion. And if you cannot get rates down on the short end, and you cannot get rates yields lower on the longer end, you're looking to repeat that and a little bit more because, of course, the big beautiful bill has its own deficit, which now adds to the debt that we already have. So each year is only going to get worse. It's an unsustainable path. Most doors are closed because you have to get the level of debt down. Well, to get the level of debt down, you need a surplus. So you first of all have to get rid of the deficit. That's not going to happen this year. It's not going to happen anytime over the next 4 years. I just don't see it. So you're not going to get the debt down because you can't get the spending down. You could get revenues higher, but this is a administration that is interested in keeping taxes low, extending the tax cuts, and even introducing more tax cuts. You do have taxes coming in the form of tariffs, but I don't think it's going to be enough to close that deficit and to create a surplus. It's not going to make America rich again. This administration is going to make America even more indebted and even poorer, even though it is a very rich country. If you're using that as your base mark, it is in the direction of poorer, not richer. You did have a bunch of debt that had rolled over this year, most of it already done. The extra increase, if this passes the Senate, because you have the debt ceiling, right? The extra increase is going to be a step function up on this one. So the fiscal path, I think, is closed. And since the fiscal path is closed, this can only end badly. You have a monetary path, which means you have the short rate. You can lower interest rates 100 basis points this year. That would help a lot. Lower interest rates 100 basis points. The other thing that you can do, Wall Street Journal ran a story about this week, is that the big banks, a consortium of big banks, are looking at introducing their own stablecoin. You know, why let a private business do it, a non-bank business do it? It's only going to take deposits away from banks. As I move $5,000 from my bank to my broker, who then takes the $5,000 to buy T-bills and gives me stablecoin. They have to hold it in T-bills, and my broker will get the return on the T-bill. And I'll have the stablecoin to do what I want to do with. Well, my deposit was paying me nothing anyway, so it's not like I'm giving anything up. But the bank is losing my deposit, which was a cheap source of funds. So why not issue the stablecoin themselves? They can at least get the money market rate. Now you get those two things happening. Remove regulation, really accelerate the adoption of a stablecoin. You can bring in maybe $2 trillion, $1 trillion to $2 trillion into the T-bill market, just backing stablecoin. Lower rates 100 basis points on the front of the curve at the same time. You will squeeze a lot of money out of the money market because you'll be fighting for the same securities at lower return. Keep in mind, there's a record amount of money in money market funds right now because it pays so well. You would squeeze that into the capital market curve, the 2 to the 5, easy, because that's not a hard decision to make to go from, let's say, a one-year T-bill to a 2-year note. Well, that would then force the existing money that hangs out at that part of the curve to go a little bit further, maybe out to the 5 to the 7, which would then squeeze the clientele in the 5 to the 7, maybe out to the 10, which might squeeze some of the clientele in the 10 out to the 20 and the 30, like a tube of toothpaste. But Treasury can't get that done on its own. Banks can't get that done on their own, even if they do introduce a stable coin and you bring a new buyer into the T-bill market. It doesn't do anything to the interest rate. This is what we have to do. We have to have the Fed lower the rate, and if we don't want the central bank loading up their balance sheet with securities, we have to find a way to squeeze all that money in the money market out to the capital market curve. These two things can do it. Stable coin, yeah, I think you could probably get that done. The Fed lowering rates, well, if we listen to the Fed, they're in no rush to do anything. They're in a good place. This is why I think Trump is probably going to introduce a new Fed, maybe not replace Powell or fire him, but certainly announce a new Fed with new policy, probably before reciprocal tariffs date of July 8th. Heading over to real rates, look at this. We have two new entries on our chart here. May 21st, the 20-year real rate hit a new cycle high of 2.58%, and the 30-year real rate hit a new cycle high of 2.75%. The 10-year is very far away from it, 218 to 249. A lot would have to happen on the 10-year. 10 years a little over 4.5%. On a nominal basis, you'd have to start pushing up to 4.75, 4.8, 4.9. You could probably put a new high real rate here. Break-evens not showing any real change. Inflation expectations, if we think about it in terms of the break-even rate from a bond investor perspective, all well anchored. Going out to the 5-year 2.4, 2.35, 2.33, 2.48. These are they're over 2%, but they're certainly not 3.5, 4, 4.5, 5% like we get in the consumer confidence surveys. OAS, nothing to see here. Investment grade, the investment grade. IG, AA, triple B, all contracted, and high yield spread out a little bit. We go over week TLT, and yeah, well, what else is new here? We should just put the negative sign in as a permanent sign in front of TLT. SPX down 2.61%, considering the debt downgrade, considering the rise in the yield curve, which affected the market on Thursday. Looked like it wanted to recover Friday till the orange man came out and said a couple of stupid things. 2.61. Dollar index down 2% as well. It's the combination of these things together that you typically don't see. Usually SPX down, you have both of these up. They tend to move together, but they're all moving down at the same time. Let's talk about Bitcoin and MicroStrategy. I have that trade in play. I am long IBIT and I am short MSTR, such that I am Bitcoin neutral, very close to zero. Now, it doesn't happen every day because they don't move in lockstep every day, but typically zero. MicroStrategy has 576,000 Bitcoin, market value of 62.38 billion, but they have a market cap of 101 billion, so they're selling at 1.62 times the price of Bitcoin, and let's be honest, they're really nothing more than an actively managed ETF at this point. They got a money-losing software business behind them. Call the loss on that the expense fee for running this actively managed fund, and they're issuing shares. Not so much debt anymore, issuing preferred. They just announced another preferred issuance and issuing shares to get this done. So there's an ARB play here. And Jim Chanos, I think 2 weeks ago, announced that he was doing this as well. Bitcoin 5-day up 6%, MicroStrategy down 6%. This has the footprint of ARB. Because if you're putting an ARB position on, you have to buy Bitcoin and you have to short MicroStrategy. So I would not read too much into the gain on Bitcoin and say, aha, Bitcoin, everyone's going to run to Bitcoin. They don't want treasuries now. It more than likely is reflecting not just Chanos doing it, but many other funds looking at this saying, hey, yeah, he's got something here. Now's the time. The volatility on IBIT and on Bitcoin and on MicroStrategy has lowered considerably. And because the volatility is lowered considerably, this does make a smarter play. Chances are the run-up in Bitcoin that we've seen is not so much demand for Bitcoin, but demand for one leg of the ARB strategy, because you do have to buy this and sell this. The fact that they are moving like this suggests to me a very strong ARB footprint. You pushed one up 6% because you have to balance them. You have to be as neutral as possible. So you would expect them to offset each other by pretty much the same percentage if the volume coming into here also represents the volume that's pushing this down. You would expect this kind of pattern. So if the position is in place right now, then I don't see continued gains in Bitcoin unless you have momentum demand coming in and pushing it higher at these levels, which it typically does. It draws money in, but without the buying support of the ARB funds that would have been buying Bitcoin and selling MicroStrategy, it's not going to have the same lift upwards. It wouldn't surprise me if the ARB is in place at this point, if it tends to go sideways for a while before it starts drifting back down. 1.62 for you conspiracy theorists out there who want to read something into this. That is a Fibonacci number. Right? I think funds would probably begin to exit this around 1.2, 1.3. So MicroStrategy does have some downside to go. Finished, I think, under 370, 369. This one worked out very well for me last week because, like I say, I am long IBIT and short MicroStrategy such that I'm Bitcoin neutral. Up 6% and I'm long, thank you. Down 6% and I'm short, thank you. It was a good week last week. Give me one more week like that, and I can exit my trade on that one with very nice return on this one. Let's get back to rates here. I just thought I'd throw that in. Look at your 30-year, 6.86, up 5 basis points. 10-year was up 10. This is up 5. This is what's going to happen. You get this 10-year that starts saying, no, we want 4.6. No, we want 4.7. Let's go all the way to 5. You're going to get this over 7%, 7.2%, 7.3%. Housing market is going to head straight down. And a 10-year that's starting to do this, look for your equity market to head straight down as well. Last week, I had laid out an argument that because the market had rebounded so much, I listed off the tariffs we have. You have a 10% universal tariff that happened April 5th, 25% on cars and parts with some exceptions. That went in on May 3rd. 30% on China, 100% on cars. There are some exceptions to what's coming out of China. That was May 13th. And you got 25% on Mexican and Canadian product that is non-compliant with U.S. MCA. These are all in place, and you had this thing going on in the market, another V-shape. And I said that will only embolden the administration to say, see, the market's okay with this. We can do more. And of course, Friday morning he did more. So Tim Cook of Apple, not Tim Apple of Cook. It used to be Tim Apple. Now it's Tim Cook of Apple. iPhones must be made and built in the United States to be sold in the U.S. Well, that would, by most estimates, put an iPhone in around $3,000 to $3,500, basically just killing the demand for this thing altogether. A tariff at least 25% must be paid by Apple to the U.S. Oh my God, an acknowledgement. An acknowledgement from the orange guy about who is actually paying the tariffs. I thought if they were made in India, India would be paying the tariffs. But apparently, no. Apple will be paying the tariffs. A U.S. company will be paying the 25%. By the way, it is cheaper to have Americans pay the 25% tariff than it is to attempt to make it in the U.S. Besides, you can't build a plant that fast to build those things because you're going to build it with automation. And all Apple will do is wait this guy out. He'll just wait him out, and he'll just say, well, let's just work on the 25%. Let's deal with that, but we'll wait this guy out. And then, of course, there's the European Union. How about 50%? Because keep in mind, the reciprocal tariffs, July 8th, Europe avoided reciprocal tariffs, but they're back in by July 8th. That's 44 days or 6 weeks. China's August 12th. And I'm sure that's a typo. I don't think the president thinks that's 250 billion. But he is either not very intelligent, or at least he knows better but thinks you're not very intelligent, right? European Union, which was formed for the primary purpose of taking advantage of the United States on trade. These countries all got together and said, you know, why don't we all get together and do this? We'll have a common central bank, a common monetary policy, for the sole purpose of screwing the U.S. on trade. Come on. Has been very difficult to deal with. You mean they're not just rolling over for you? No. There are powerful trade barriers, VAT taxes. That's not a trade barrier, by the way. Ridiculous corporate penalties, non-monetary trade barriers, monetary manipulations, big question mark there, unfair and unjustified lawsuits against American companies, and more have led to a trade deficit with the U.S. of more than $250 million a year, a number which is totally unacceptable. It's $235 billion, and that's just in goods, okay? So 250 million, I think he meant to say 250 billion. It's really 235 billion. If you put the whole thing in there, goods and services, the trade deficit with the EU is 161 billion. The 250 million is really 235 billion. And that's just for goods. I'm recommending a straight 50% tariff on the EU starting June 1st. That's next Saturday. June 1st. Not going to wait till July 8th. June 1st. Why? Because the market gave him permission. He looked at the market. He said, see, they're okay with this. We can do more. And I said, if we continue on like this, it'll give the administration more willingness to throw more tariffs out there. So if we rally this week in the market and we head back to the 590s, this is more than likely going to happen. I also am here. I don't think tariffs are done no matter which way you go. I don't think they're done. So I think the market attempting to reclaim all-time highs and this idea that we can end the year at 61, 62, 63, I think it's just a dream. Government needs revenues. You can get revenues from taxes or growth. Taxes are tariffs. Tariffs are taxes. Same thing, right? And growth, you make it here, there is no tariffs. So attempting to say, well, we'll grow our way out of this. We're not making multi-billion-dollar and multi-billion-dollar investments when in 2 years you are probably going to get swept in the midterms, and in 4 years we might have another administration in here. But I'll tell you what we'll do. We'll announce it just to placate you, right? You still have the reciprocal tariffs, July 8th. That's not done. Don't put that on a shelf and say, well, that was a fun time. That's coming back. That is coming back because you need revenue. China, August 12th. That's not done. 50% EU, June 1st. 25% iPhones. He also said, oh, no, Samsung as well. Plus, keep in mind, he mentioned, well, there'll be copper, there'll be lumber, movies, semiconductors, pharmaceuticals. No date given on that. However, there is a growing acronym that's used in the rest of the world, TACO, which is emboldening other countries to stand pat, to not negotiate because of TACO. Trump always chickens out. Okay, let's have a look at SPY. Here is our big V-shaped recovery, and then some thinking about it over here. You could be forming a reverse head and shoulders over here, and if you do, well, that would imply one hell of a rally from there, right? Let me get that mess off the screen. It's like a Madden football hour here. Forward 4-quarter operating earnings 269.52. It is a drop, but it's not a big drop. Maybe it's starting to stabilize a bit. I think 260 was a destination on this. And I keep saying, 18, 19, 20 times. I'm going to show you shortly. I challenged Gemini. I said, I want you to disagree with everything I say. And then I said the index at 21 times forward earnings is overvalued. And it had to disagree with me. It had no choice but to disagree with me. And it had some pretty good disagreements. So we're going to have a look at that. 269.52, you had closing SPX of 58.02, which is lower. So lower earnings, but lower index. Lowered the multiple, 21.53 down from 22.07. Now this is not bad. We are down 5.43% from the all-time high. The week before we were down less than 3% from an all-time high. To only be down that much on the debt downgrade, the market had to absorb that. The poor 20-year auction, I put a question mark here because I don't think it was poor, but okay. And Apple Pays in EU 50% to only go from 2.963% down to 5.43, 2.5% over the week to absorb all of that. It's not bad. But if the market says, okay, no, let's head back up, the higher it goes, the higher the probability that you're going to get the tariffs that are announced and even more. And the market will have to absorb that. And if it attempts to go higher, well, then you'll get even more of them, right? The market is the only boss that Trump has right now, and the equity market gives him permission. The bond market is going to be the one that fires him, right? He's paying attention to the wrong market. Some implied volatility is back, 45th percentile over the last 13 weeks, up from 9. Last IV was 18.5. IWM, IJR, and Triple Q all down for the week, but IWM down 16.3 from its high. It is out of bear market territory. Same with IJR, in correction but out of bear market, and Triple Q is down 5.81% from its all-time high. It has not re-entered correction territory. Same with SPY, not in correction territory either. LSEG 13 reporting this week, and the same number. Wouldn't it be nice just to have one reference? Some notables: Tuesday AutoZone, Wednesday Salesforce, Thursday HP, and the big one, NVIDIA. I see no reason why its numbers would disappoint. I see no reason why its guidance would disappoint. The only issue is growth, because it may be at its capacity in terms of semiconductor manufacturing out there. It may have all the bandwidth it has right now, and there's no room to grow into it. So The growth number would be the only questionable thing, but I don't see the AI build out at this point, or well, I shouldn't say the build out. I don't see it. I don't see it falling off a cliff. Maybe plateauing, but at a high level. And this is a cash flow generator at this point. So let's just keep our eye on this one. This is Thursday. I say Thursday because they tell me Thursday. I'm not fact checking their dates, but there you go. Friday you have Dell and Costco. Looking at their lowest close, SPY, IWM, IJR, and triple Qs, and then looking where the bull market is. For SPY, it's anything above 588.69, 579. We were in a bull market. We are slipped out of the bull market. We are not in correction. We're not in a bear market, but we're not in the bull market. IWM, anything over 206.94. Same thing with IWM. Not in a bear market. In correction, but not in the bull market. IJR, we could say the same thing here. And triple Q, 492.21, still in a bull market. Not in correction territory, not in bear market territory. It is in bull market territory, comma, so far. Okay, let's discuss a few things. We're going to talk about the one big beautiful bill, because that made it through the House on its way to the Senate, where it is going to face some trouble. You know, I like my news feed. When I wake up in the morning, I take my iPad, tap on Apple, and I go through the headlines. I go over to Wall Street Journal, Barron's, not so much Barron's on the weekday, but I look at what the headlines are. Sometimes I find stories that are interesting. I start reading them, but they don't have all the information that I would like to have. So you start searching for other stories that are along those lines, but they tend to all have the same sort of talking points. So there's a lack of good journalism that dives a little bit deeper. You can use your models, whichever LLM that you have. They all have internet tools, so you can click on tools and you can ask it to connect to the internet, and it can do some searching for you. I have Gemini Pro on the screen. I'm using the 2.5 Flash model, and I start with saying, give me a broad overview of the one big beautiful bill. Just give me a broad overview, and then from there, as I read that, I may ask particular questions, right? You can create your own journalist by doing this. Is you search, is you think, well, there was this headline, this happened. You can put that in. Tell me what you know about this, and then you can start to probe it for follow-on questions, sort of having your own journalist right beside you that you're doing an interview with. Broad overview of the one big beautiful bill. Tax cuts and extensions, the 2017 tax cuts, new tax relief, tells you tax on tips and overtime pay. Temporary, we have the temporary deductions for the interest on auto loans for U.S. assembled cars, increase in the child tax credit. SALT deduction increase from $10,000 to $40,000. Business tax incentives, border security, social programs, Medicaid, significant cuts and eligibility changes to Medicaid. And SNAP reforms, includes reforms to SNAP requiring states to contribute more and adding work requirements. Other provisions, air traffic control modernization, energy policy, aims to support domestic oil and gas exports, roll back certain climate policies. Trump accounts, because of course, the bill initially included MAGA accounts, later changed to Trump accounts, which are a new type of savings account with certain tax benefits, including a baby bonus for children born over the next 4 years, and only the next 4 years under Trump's administration, because that's what dictators do, right? If you remember your Chinese history, if you remember the dynasties, it was very common for individuals to have the same last name as the emperor. Trump accounts, fiscal impact and political context. The bill is estimated to add trillions to the national debt over the next decade. So I pushed back on that. Well, didn't push back, but I said, tell me more about that, right? Highly contentious piece of legislation drawing strong reactions from both sides of the political spectrum. Section 899 is particularly important because it begins to tax other citizens Retaliation against unfair foreign taxes. It's meant to counter tax regimes enacted by other countries that the U.S. views as discriminatory or extraterritorial, disproportionately burdening U.S. taxpayers. And then give some examples of unfair foreign taxes. The digital services tax is something Canada has. Section 899 targets applicable persons. These include non-U.S. individuals, foreign corporations, trusts, and certain entities that are taxed residents of or controlled by residents of a discriminatory foreign country. And Canada is in there. Increase on withholding tax rates. So it goes from, here it is right here, the increase in tax rates is going to be 5% for each year, capped at 20% above the otherwise applicable statutory tax rate. Canada has a tax treaty with the U.S. We don't have any withholding on U.S. interest, but we have, I think, 15% withholding on dividends versus 30%. This would start to increase that withholding by 5% a year for as long as the digital service tax remained in place until it hit 50%. This means even a treaty provides a reduced U.S. tax rate. The 5 to 20% increase would be applied on top of that treaty reduced rate, potentially leading to much higher tax liabilities. Impact on foreign governments, modification, implementation uncertainty. The increase would apply to tax years beginning after a certain period following enactment, usually 9 or 180 days after a country is officially listed as discriminatory. Tell me about the elimination of energy incentives. Electric vehicles, EV credits. This is not as bad as the market reacted to it, by the way. And this is by no means a done deal. Proposes repealing the tax credits for new EVs, previously owned EVs and commercial EVs. The new EV credit would end for vehicles placed in service after December 21st, 2026. That's all the way to the end of next year. Used vehicle credit would end earlier, starting in 2026. Residential clean energy and home efficiency credits. The bill would terminate these credits by December 31st, 2025. Dramatically accelerates the phase out of the popular 30% solar tax credits for homeowners, which was initially slated to gradually be reduced through 2024. Clean energy production and investment credits. Let's see, what do we have here? Projects hoping to qualify for these credits must begin construction within 60 days of the bill's enactment. It has not been enacted at this point. It's got to get through the Senate. They're hoping for July 4th. They got to begin within 60 days and be placed in service by December 31st, 2028. This effectively eliminates the previous phase-down schedule extended to 2032. So it's not as if they're all going to end. As long as you begin construction within 60 days of the bill's enactment and completed by 2028. Advanced manufacturing production credit, clean hydrogen production credit, carbon oxide sequestration credit, that would affect Oxy. Restrictions on transferability, prohibited foreign entities limitations. So there's a bunch here, other related impact and lookout. With growth rate in GDP, what growth rate in GDP did OMB use when scoring this bill? And they tell you short one, real GDP, 4.2 to 5.2. The bill is projected to boost short run real GDP by 4.2 to 5.2%. I got a problem with that. That is aggressive, but it does give me a link to house.gov to see it. Long run real GDP is expected to increase long run by 2.9 to 3.5. If that's the case, the assumption that you can grow your way out of it is right in those two numbers. Short run by 4.2. This is real, by the way. 4.2 to 5.2. Real. That's not nominal. Throw another 2% on top of that to account for the inflation figure. What can we expect as it goes to the Senate? This was, it's out of the House now. A rewrite is almost certain. House bill passed by a single vote represents a specific set of compromises made to get it through that chamber. The Senate, different political dynamics and individual member priorities, is highly unlikely to pass the House version as is. Key sticking points, spending cuts, especially Medicaid and SNAP, Many Republican senators, even those supportive of tax cuts, are expressing concerns about the depth and nature of the spending cuts. Senators like Josh Hawley, Jerry Moran, Susan Collins voiced concerns about potential impacts on rural hospitals. Some senators are pushing for even deeper spending cuts to offset the tax breaks, while others are wary of the political ramifications of cuts to safety net programs. Particular concern about shifting food aid cost onto states, which could be an issue for some red states. Energy, clean energy. The House bill's aggressive elimination or rapid phase-out of many Inflation Reduction Act clean energy tax credits is a major point of contention. Several Republican senators, including Shelley Moore Capito, Kevin Cramer, John Hooven, Lisa Murkowski, Tom Tillis, have indicated they want to see changes to these provisions. They argue that preserving these credits is important for job creation and investment in the state, and I agree. This is spending for investment in productive assets. This is not bad spending. It's actually pretty good spending. So it's not a done deal. Highly restrictive prohibited foreign entities rule, which could effectively nullify many credits due to supply chain issues, is also a significant hurdle and a likely target for modification. It is quite common in a bill going out of one chamber into another that you'll put some things in the bill that you know the other chamber is going to have an issue with, but that you're just simply going to use as a negotiation tactic. You don't want them in there, and you know they don't want them in there. But if you don't put them in there, you're going to have to give up on the things that you wanted in there. So what you do is you put things in there that you don't really want in there, that you know they don't want in there, that when they get to it, you say, okay, listen, we'll give you this, but you got to give on that, so that you get the things you want and you give up the things you didn't want to begin with. I have a feeling nobody really cares to have this in here. Performance of tax cuts, or permanence of tax cuts. Some Senate Republicans want to make more of the tax cuts permanent, which would further increase the bill's cost. Debt ceiling increase bill includes a substantial increase to the debt ceiling. While necessary, some fiscal conservatives are very wary of voting for a large debt ceiling hike without commensurate guaranteed spending cuts that they believe will generally address the deficit. Senator Paul has indicated he might be a no if it includes a debt ceiling hike without significant deeper cuts. 899, broadly supported by proponents of the American First Agenda. The aggressive nature of Section 899 and its potential to override tax treaties could raise concerns among some senators who prioritize international tax stability. Reconciliation rules and the Byrd Rule, because they are using budget reconciliation for this. Bill is moving via budget reconciliation, which allows it to pass the Senate with a simple majority. This bypasses the typical 60-vote filibuster threshold. However, reconciliation bills are subject to the Byrd Rule. This rule prohibits extraneous provisions that do not have a direct budgetary impact or that increase the deficit beyond the 10-year budget window. The Senate parliamentarian enforces the Byrd Rule. This means certain provisions, particularly those with a policy focus but minimal direct fiscal effect, some detailed policy mandates within the border security section, or some of the specific language around social program requirements, could be struck from the bill. This could necessitate changes to the House's language to ensure compliance. The fact that many of the House's tax cuts are temporary is often a way to comply with the Byrd Rule, as making them permanent would likely violate the rule by increasing the deficit beyond the 10-year window. The Senate wants to make more cuts permanent. They will need to find offsetting savings within the 10-year window or risk running afoul of the Byrd Rule. The timeline, hoping for July 4th. There we go. Are there any new sources of revenue in this bill? Section 899, which is contentious to begin with. Immigration-related fees. This is all pretty contentious as well. Visa integrity fee, projected to generate $29 billion. Fee for asylum applicants, $13.6 billion. The Form I-94 fee, generate $10.8 billion. I don't know what that is. Is that so that you can drive on I-94? Diversity immigrant visa fees. Oh no, that's so immigrants can drive on I-94. 5.6. Fee for temporary protected status, 4.4. Other immigration fees, 10.9. Remittance excise tax. A new excise tax on money sent overseas by non-U.S. citizens, initially proposed at 5%. The bill includes a 3.5% excise tax on remittances. So you want to send money overseas, there you go. Increase to certain excise taxes on private university endowments. This gets pretty wicked. Bill replaces the current 1.4% excise tax on the net investment income of private colleges and universities with a tiered system. For institutions with a student-adjusted endowment of more than $2 million, in other words, very large endowed universities, excise tax would increase up to 21%, 1.4 to 21%. It also expands the scope of what constitutes net investment income. Provision is estimated to generate $23 billion. Such a small amount, $23 billion. Repeal or phase out of green energy tax credits, while not a new tax. Repealing the EV tax credits, $191 billion. Phasing out of energy production manufacturing, $237 billion. Other IRA credits, $131 billion. Reducing ACA overpayments and payments to immigrants. This is the Affordable Care Act payment. Fraud, waste, and abuse. $181 billion. Modify de minimis entry privilege for commercial shipments, another $39 billion. Expand executive compensation deduction limits. I asked for more background on that. Point 8. So give me more background on and detail about point 8 in your previous answer, and it gives you some background on what this is. The $1 million limit was introduced in 1993. Covered employees to $1 million per year. Original purpose, and you wonder, well, why do you want to limit the compensation? It's to tie most of the compensation to performance and not just here's your paycheck. The initial intent was to curb excessive executive pay by removing the tax incentive for companies to pay executives more than $1 million. It also aimed to encourage performance-based compensation. And then it changes the definition of covered employees. Here's what the one big bill proposes on this one. And why is this a revenue raiser? Based on sentiment, in your opinion, this was a wild card. Based on sentiment, I thought I'd get an answer, but I'm asking the LLM for its opinion. Based on sentiment and your opinion, is this a good bill or a fast bill? I wanted to see specifically how it handled this. Based on expert opinions, the one big beautiful bill is far more accurately described as a bad or divisive bill than a good one, at least from the perspective of many independent analysts and a significant portion of the political spectrum. And here is a breakdown. Overall sentiment, heavily negative, divisive. Reverse Robin Hood. Well, of course, Elizabeth Warren would be in there, right? Taking from the poor and giving to the rich. If you tax me excessively and give it to poor people, that is taking from the rich and giving to the poor. If you then say, oh, hang on a second, we tax too much. Let's still tax you a lot, but not as much as we used to. That's not transferring from the poor to the rich. That's just transferring from the rich to the poor a less amount. So I question this reverse Robin Hood thing. That is it just that you're, instead of taking an excessive amount from successful people and giving it to unsuccessful people, you've taken, instead of an excessive amount, just a lot, and making it look like it's a transfer back? I question that. Fiscal irresponsibility and debt bomb, I agree with this. Impact on healthcare. Deep cuts to Medicaid and other social safety net programs are a primary target of criticism. Undermining clean energy transition. Hidden provisions, threats to democracy. Some analysts point to hidden provisions such as those limiting judicial contempt powers or imposing a 10-year ban on state AI regulations related to elections. These are seen as attacks on the rule of law and democratic process. Cruel, irresponsible, flaming scam. Arguments for being good, primarily from proponents: economic growth, tax relief and certainty, border security, energy dominance. My opinion, this was surprising when I saw that. As an AI reflecting consensus, my opinion. I'm thinking, that's impressive. Let's see. Given the overwhelming independent analysis and the sentiment expressed across a broad range of sources, blah, blah, blah. It is highly likely the bill would be viewed as bad by a majority of objective observers and stakeholders. Primary reason: immense projected increase in the national debt, significant cuts to social safety nets, safety net programs that affect vulnerable populations, detrimental impact on the burgeoning clean energy sector, concerns about its fairness of its tax provisions. And there we go. This is so you can continue to do this. Whatever story you want more information about, just head over to one of your models. I got to tell you, I rarely Google anymore. I wanted to know more about this. This was my go-to. Give me a broad overview, and from there I'll determine what questions I want to ask after that. But you go to Google, you do this, you're going to get your traditional media, which you can click. You can see MSNBC. Oh, this sucks. Well, of course you say it sucks. I don't even click on it anymore. Fox News. This is the most amazing thing. Well, of course it's the most amazing thing. I don't even click on it anymore. Like you just don't click on these things anymore. I find that this was a little bit, not a little bit more balanced. It was significantly more balanced because it is giving me arguments on both sides. I did another one over here. I want you to offer a counter, and this is a nice strategy you can use to check your blind spots. Let's say that you decide that you like a particular stock, or that you like a particular piece of legislation, or that you agree with a particular social policy. You can get the LLM to disagree with you on purpose on everything you say, just to check your logic. And I also set a trap for it. And to see how it would handle a trap, because in debate, it is one tactic you would use is to set a trap for the other side, knowing the other side cannot disagree with what you just said. They must agree, but by agreeing, you trap them into what they've already said to say, aha, then you must conclude this. So I put a trap in here. Here's how I start, and you could do this with any LLM. I think, let's say that you decide that I like a certain thing. You may have only read stories that support your position, and you're not thinking about the other side. Prompt an LLM to do this. I want you to offer a counter argument to every statement that I make. You're free to use the internet to find data and facts that would help you. And Gemini says, okay, I will offer a counter argument to every statement you make, drawing on data and facts from the internet when helpful. Lay out your first statement. I'm ready. U.S. fiscal deficit and current debt level are on an unsustainable path. We hear this all the time, on an unsustainable path. Are we missing anything? The privilege of the U.S. dollar and global demand for treasuries. U.S. dollar remains the world's primary reserve currency, and U.S. Treasury bonds are considered one of the safest assets globally. Even after the downgrade, even with the debt level now, they're still considered that. Creates consistent, robust demand from international investors, central banks, and other entities, allowing the U.S. to borrow at relatively lower interest rates than other countries might with similar debt-to-GDP ratios. Productive investment, economic growth. Not all debt is created equal. If government spending contributes to productive investments in infrastructure, education, research, development, clean energy, it can boost long-term economic growth. This is one thing I picked up on right away, going, well, good. That's why I didn't like the pullback in the funding for green energy in the One Big Beautiful Bill. I thought it was, well, okay, I get it. You like coal. You want to drill, baby, drill, but to punish the other side. You can support one side without having to punish the other side. That's just not in Trump's nature, though. So yeah, this is a good argument, but but that's not what happened. It can boost long-term economic growth, historical precedent, and adaptive capacity. And I said this during the week. Somebody had pointed out that something was the worst it's been since 1970 something, and I said, well. In 1970 something it was there, and look what happened. It must have worked out because we got all the way here. Market went up, bond yields went down, inflation got here. So it must have done something. So if it's the worst it's been since then, it's not like we've never been here. It's like, well, maybe this will cause the same reaction that fixed it last time, right? This is what this is saying. U.S. has seen high debt to GDP ratios before. After World War II, 119%. Economy was able to grow out of that debt through a combination of strong post-war economic expansion, relatively low interest rates, and some fiscal adjustments. But hang on, a much higher tax rate overall for everyone. So yeah, while it pushes back, I can at least push back each time. Now, I could push back on this and say, wait a minute now, you said this, there's this, and it would then, because its job now is to offer a counter argument, then offer counter arguments against that. U.S. interest rate versus growth rate, R minus G. R being the average interest rate, G being the growth rate. We saw the average interest rate almost 3.3% right now, which means real GDP, nominal GDP must be greater than 3.3%. Demographic and structural factors are adaptive, while rising mandatory spending on Social Security and Medicare due to ongoing aging population is a major driver of projected deficits. These are not immutable laws. Policy adjustments, however politically difficult, can be made. Changes to eligibility ages, benefit formulas, adjustments to tax revenues dedicated to these programs. The unsustainable path is a projection based on our current policy and policy change. The risk of austerity. You could get a lot of cutting. So I can look at these arguments. I could say, number 6, not going to happen. Number 5, probably not going to happen. Number 4, the interest rate is already very high. And the R minus G, we're close to it equaling 0 at this point, if not going negative, if R goes any higher. Historical precedent, sure. But I would argue that we had much more responsible government back then, much more qualified government, less populist, with much higher tax rates than we do today. We have much more populist governments now. Productive investment and economic growth, that was gutted. Much of it was, at least in one sector, was gutted. And privilege of the US dollar, slowly waning. So, okay, you've pushed back. Tariffs will cause inflation, and AI will cause unemployment. Both tariffs and AI are happening right now. This creates a stagflationary environment in which G is low and R is high. D to GDP over 100%. The ratio will only get worse unless the Federal Reserve lowers rates now. Counter arguments to tariffs will cause inflation. Substitution effect. So it's saying it doesn't have to. Substitution effect. They may shift from higher price imports to domestically produced alternatives or from non-tariff countries. Well, they all have 10%, so that's out. Producer absorption. Foreign producers might absorb a portion of the tariff. Strong dollar offset. Well, we don't have that. Temporary versus persistent. Tariffs can cause a one-time price level increase, not necessarily sustained inflation. Domestic production stimulation. This is what the administration is hoping for. If you build it here, there are no tariffs, right? Counter argument to AI will cause unemployment. Job augmentation, not replacement. AI will primarily augment human capabilities rather than entirely replacing jobs. Creation of new jobs. Increased productivity and economic growth. If AI significantly boosts productivity, it could lead to higher economic growth, which typically generates more overall demand. Shifts in skills demand. Rather than mass unemployed, AI is more likely to cause a shift in the skills required for many jobs. Let's continue here. Workers who can collaborate with AI, manage AI systems, or apply AI tools effectively will be in high demand. I'm going to highlight that. I've said that at the beginning in the introduction. This is it. This is a skill that is not a nice to have. In a year, in 2 years, this will be an absolute drop-dead need to have. You want a 2-year head start. Non-routine and interpersonal skills. Many jobs, particularly those requiring complex problem-solving, emotional intelligence, creativity, critical thinking, interpersonal interaction, are far less susceptible, I'm glad he said it that way, to full automation. Why did I say he? My LLM is a he. Did you see what I just did? I'm glad he said it that way. Look at the bias in me. Are far less susceptible. Well, actually, it made mistakes, so she's not that good. As far as less... I'm going to get emails. As far as less susceptible, are far less susceptible to full automation. Doesn't mean that they're not. They're just less. Counter arguments to this creates stagflationary environment. Tariffs limited impact on growth. A limited impact on growth. Large-scale trade wars can harm global growth. The overall U.S. economy is heavily weighted towards services. This is true, 80%. AI's potential for growth. The nuance of R minus G. While R greater than G is a concern for debt sustainability, the relationship is dynamic. The Fed's actions influence R. They do influence R, but so does the market, but so do global capital flows. Okay, there we go. Inflation expectations, fiscal policy. If AI does lead to higher productivity, it could ultimately increase the potential growth rate of the economy. Also, R represents the average interest rate on the debt. Much of the existing debt was issued at lower rates. Well, we've already shown how that rate is going up. Counter argument to unless the Federal Reserve lowers rates now. Inflationary risk. If they do, you run the risk of inflation. A loss of credibility. Limited impact on structural issues. Lowering rates might offer short-term relief on interest payments, but doesn't address the underlying structural issues driving deficits. That's not the Fed's problem to solve. Bubbles and imbalances. Fiscal space and moral hazard. If the Fed consistently bails out fiscal profligacy with low rates, it could reduce the incentive for Congress to make difficult but necessary fiscal adjustments. This is a bad situation, and they failed to make the proper adjustments. If they cannot and will not do it, the Fed has no choice but to do it. You know, you don't want to say to your kids, look, I don't want to bail you out every time because you'll never stand on your own 2 feet. But if you can see that they're barreling towards destruction and they're not going to do a damn thing to help themselves, you got to step in. Here I'm setting a trap. AI will not be a general purpose technology. Given the capital investment requirements, AI will be inflationary. I wanted to argue that AI is general purpose and that AI is not inflationary. I particularly wanted to argue that so I can then say, aha, you said this and this, plus this other thing, so you must admit this. And I want to see how it works its way out of a logic trap. Made two distinct but related claims. AI will not be a general purpose technology, and it'll be inflationary. So what does it say? Pervasiveness, a key characteristic of a GPT. That's a pre-trained transformer, generative pre-trained transformer. Is its applicability across a wide range of industries: healthcare, finance, manufacturing, education, creative industry, services. Rapid improvements, complementary innovations. They don't just change existing processes, they enable entirely new innovations in industries. Already fostering a wave of complementary innovations, AI-powered software tools to new business models built entirely around AI. And this past week, we saw OpenAI by John Ives' company. Now they're going to make devices embedded with AI. Google partnered with Warby Parker that makes glasses to embed AI into those. So AI is going to find its way, what's called embodied AI, into devices everywhere. I can use my iPhone. If you have Google AI Studio, which you can get from Chrome, there is I'm going to show you shortly, there's a stream feature, and I can use my phone to turn on the camera like a webcast. And I can go to Home Depot, and there could be 15 items of a thing that I want there, and I guarantee you I'll take the wrong one home, because they all have slight modifications. You go to Home Depot, say, I need some drywall screws. Well, what size screws? I don't know. Oh, ceramic, glass, metal, I don't know. You know, there's like 15 modifiers for something simple, and I don't know the answers to any of these, right? And if you go to Home Depot and you don't know, you got to find an orange apron somewhere. Good luck finding an orange apron on a weekend. Well, you can hold up your phone like you're webcasting, and you can ask the AI, what's the difference between this and this? And it'll tell you. Okay, what's the difference between this and this? And it'll tell you. And say, okay, well, here's what I'm using it for. Which one of these four do you suggest? And it will tell you. I brought it outside my front lawn, and I showed it the weeds growing in my front lawn. I told it where geographically I lived so that it had an idea of the type of earth or the ground that was here. And the climate and weather conditions, and I pointed to it, and it named the weed, and it named the fertilizer, the weed killer, that I would get. It also noted that my grass was growing not in an even way in certain areas, and it recommended a fertilizer at the same time. So I asked it, can I get that at the Home Depot in my neighborhood? And it answered back one moment, came back, said, yes, you can. They are in stock at these Home Depots. Do you want the price? Shall I place an order online? No, that's good, thank you. So I didn't have to bring somebody over who knows about weed saying, look, this is what I got going on in my grass. What do you think? I just asked AI. I just took my phone outside and I had a conversation with it. Isn't that crazy? Complementary innovations, that's a bit of an aside. So yeah, it's already in my phone. Transformative economic impact. Counter arguments to AI will be inflationary. Productivity gains as a deflationary force. Cost reduction in AI itself. Increased supply and competition. Initial investment versus sustained impact. Historical parallel. Internet computing. So then I say, okay, you have convinced me AI is a general purpose technology and will be a big deflationary force in the economy. You already said it. You've also convinced me that tariffs are a one-time hit to inflation and not inflationary. You already said it. So on net, you are suggesting we are entering a deflationary environment. Set a bit of a trap. AI is general purpose. AI is not inflationary. Tariffs are not inflationary. And you even said up here, what's the first thing you said up here? Productivity gains is a deflationary force. So you have to admit, right? Push back on that. Can you get out? I appreciate you engaging with the arguments and shifting your perspective. It's a sign of good economic thinking to be open to different interpretations of complex. Yeah, shut up. Get on with it, right? Demand side pressures remain. Even with some disinflationary force on the supply side, robust demand can still drive inflation. Strong labor markets. Fiscal stimulus. So I can't disagree. You do have strong labor markets in the U.S. If you give somebody a paycheck, they will spend it. Fiscal stimulus, you are still running significant deficits and projected to continue to run significant deficits. Accumulated savings, I've heard that argument brought out every single time. Inflation expectations in the bond market, in the TIPS market, they're well anchored, but in consumer sentiment, if we look at University of Michigan, they are unanchored. Geopolitical risks, supply chain fragilities, these always exist though. That's nothing much. Housing costs, they're coming down. Service inflation. While goods inflation has been more volatile, service inflation tends to be stickier. Wages are a much larger component of service costs. Strong labor markets can keep service inflation elevated. And we're seeing that is coming down. Central bank targets, 2%. They would view actual deflation as highly undesirable, often signaling a weak economy, falling demand, potentially a deflationary spiral. This is true. They fear deflation more than inflation. But I wasn't asking about will deflation show up. I was saying you must admit that this is deflationary. And if we do admit that it's deflationary, then the Fed should be lowering rates. If we agree on all of these things, I was trying to get the AI to agree with me. Then I moved on to the S&P. And I said, dude, S&P 500 index is overvalued based on a forward PE of 22 versus its historical average. Tell me it's not. You're right. It says 21.1 to 21.6 according to recent FactSet data for May 2025. So it is going out there checking for facts, indeed above the historical average. However, the counter argument, lower interest rates justify higher valuations. We don't have lower interest rates. I got to hit the buzzer. You're out on that one. Sector composition shift, the rise of tech and growth stocks. S&P 500 today is vastly different from 20, 30 years ago. Technology and growth-oriented companies typically command higher PE ratios due to their higher growth potential, now constitute a much larger portion of the index's market cap. This is true. Apple, Microsoft, Nvidia, Amazon, Alphabet. If you exclude these high-growth sectors, the rest of the S&P 500 might appear more in line with historical averages. Higher quality of earnings and profit margins. This is true as well. Many argue that corporate profit margins have structurally increased due to globalization, technology adoption, and efficiency gains. If companies are consistently more profitable than in the past, then a higher PE might be justified. Disinflationary environment. As per our previous discussion, if we lean into the idea that AI will be a powerful deflationary, disinflationary force, it can actually support higher PE ratios. In a deflationary or low inflation environment, future earnings are less eroded by inflation. This is true. Typically, if you take the 10-year and you invert it, you should have a multiple somewhere, the market multiple somewhere around there, that if you have very low rate on the 10-year, you can support a much higher multiple on the market. Earnings growth expectations. TINA, there is no alternative. Shareholder return focus, in conclusion, right? More than historical average. So we have that. Now, I then asked it a question, but first, let me lay out why I asked it this question. Well, what else can AI help with? So I asked it a question. I have to poop. Well, I didn't ask it. I made a statement. I have to poop. About 4 years ago, I remember this quite well. I had a plumber come by here to fix some things. And he said, "Can I use your bathroom?" So, yeah, well, whatever. I think I've told this story before. He plugged my toilet with his poop. When he left, I went to use the bathroom, lifted it up, and I went, "Oh my God, come on." And I had to get the plunger out. It was disgusting. It was a lot of work. It was, he plugged my toilet. So I wanted to see what counter argument the AI could come up with so that next time somebody said, "Can I use your bathroom?" I'd have my list of arguments already there. No, you can't, and here's why. Here are some good counter arguments of why you cannot use my bathroom. And I got no help. There's not really a counter argument. You should definitely go. Let me know when you're back and ready to continue our discussion. So AI cannot, at this time, do everything. I'm going to show you a neat little feature that you can find in Google AI Studio. On the left, you'll have your menu system. Click on Stream and you'll have this interface. There's a screen share. So we're going to share something from CPI. Can you see the PDF that is on the screen right now?
Yes, I can see the PDF on your screen. Is there anything specific you would like me to focus on?
My mouse is beside the title, Use of Seasonally Adjusted and Unadjusted Data. Within that section, they talk about the X13 ARIMA Seats Seasonal Adjustment Method. I would like to know more about that.
Okay, you're interested in learning more about the X13 ARIMA Seats Seasonal Adjustment Method, as it's mentioned in the Use of Seasonally Adjusted and Unadjusted Data section. What specifically about this method are you curious about?
Well, I don't know what it is. Can you start by telling me what it does?
Certainly. The X13 ARIMA Seats is a statistical method used to seasonally adjust data. Seasonal adjustment aims to remove the effects of normal seasonal variations from a time series, revealing underlying trends. Does that make sense?
Yes. Can you tell me more about it?
It combines two statistical approaches: ARIMA, autoregressive integrated moving average, modeling in seats, seasonal extraction in ARIMA time series. ARIMA models capture the correlation structure in the time series, while seats specifically extracts the seasonal components. Would you like me to elaborate on either of those components?
Yes.
Okay, would you like me to start with ARIMA or seats?
Seats.
Seats, or seasonal extraction in ARIMA time series, is a method specifically designed to decompose a time series into its different components, particularly the seasonal, trend, and irregular components. Would you like a more technical explanation?
No, that's okay. The 13 in X13, does that mean it uses 13 lags?
The 13 in X13 ARIMA seats refers to a specific version or revision of the software and methodology developed by the U.S. Census Bureau. It doesn't directly imply the use of 13 lags. Does that make sense?
Yes, it does. Thank you, that's all.
You're welcome. Is there anything else I can help you with regarding the PDF or any other topic?
Not today, thank you.
Okay, have a great day.